Hi guys, it's me Vedant, and in this video we're going to learn about passive income and dividends. Passive income, like the name suggests, is income that requires little to no effort to maintain. For example, a rental property. You earn rent from it by not doing a lot of work yourself. Similarly, there's a way to make passive income from the stock market via dividends. One of the most amazing things about dividend income is that it is practically tax free. It is highly unlikely that you get taxed on dividends because to get that much dividend, you must have your total investment in crores, if not tens of crores. A good company makes profits. Well, obviously. And these profits belong to the owner of the company, which are the shareholders. And these include common retail investors like you and me as well. That is what a share is. It's a small piece of the company that you are buying. And now you will have claim over the profits proportional to the amount of shares or stake you have in the company. When a company doesn't think they can make great use of all of the profits, they often decide to distribute some of the profits in the form of dividends to the shareholders. A company, however, could reinvest the profits instead of giving it out as dividend so they can expand. It is important to keep in mind that no company is 100% obligated to pay dividends. Knowing this, we can judge the sincerity and integrity of the management of the company depending on how consistently they are paying out their dividends. Warren Buffett famously said that dividends are your friends, but there is a flip side to this as well. An important term worth knowing is dividend yield. I'll explain it with an example. Let's suppose a stock costs 100 rupees and it has a dividend yield of 10%. This means that you get a dividend of roughly 10% of 100, which is 10 rupees every year. Well, there actually are companies that are listed in the exchange that give dividend yield up to 10%, and this is actually a huge amount considering fixed deposits give 6%. So just buying this stock ensures that you are doing better than FDs. But wait, there is some more to it. When we are calculating the return from a stock, we have to calculate what happened to the price of the stock as well. It is often observed that companies with high dividend yields have poor performing stocks. So if the stock went down by 7% and the dividend yield is 10%, your return has actually been 3%. Dividends are more stable income compared to the price of stock. So they do give protection against the volatility of stock prices to some extent. But if the dividend yield is too much, that is actually money that is getting siphoned out of the company, which could have been reinvested to expand, but that is not happening and it's just being distributed to the shareholders. And this brings me to the growth stock. It is often observed that growth stocks have lower dividend yields. They often reinvest most of what they've gotten into expanding. An example of a growth oriented company like that would be Avenue Supermarts, or DMart as it is commonly known. They'd give no dividend yield and reinvest everything they make. While looking at small and mid cap companies, you would prefer them to have slightly lower dividend yields so they have more money to reinvest and expand and grow. While looking at large cap companies, however, you would prefer them to have higher dividend yields because they don't have the same growth potential as a smaller company. A very good example of a large cap company that gives high dividend yield is ITC. They make huge profits every single year, but they have already consolidated 80% market share of the cigarette industry, and therefore there isn't much to expand, and therefore whatever profits they do make, they often dividend out a good chunk of it. I hope you're getting a good feel of dividend and dividend yield. These are not hard and fast rules but just logical guidelines. When a company cancels its dividend, it is often looked at as a negative sign because they are not capable of paying the dividend maybe. And therefore, it is often observed that when a company cancels their dividend, the stock also corrects and decreases in price. And therefore, to keep a balance, you would either want dividend stocks and growth stocks or companies that are giving lower dividends but consistently. Considering most of the people watching the video are between 18 and 24, it is more logical for us to invest and lean towards growth oriented in the balance, since we have more time to appreciate the growth and returns. If you guys haven't opened a Demat account already, you could open one using Grow as your broker. It is the broker I use and I have made a review on it as well. Make sure you check it out. That's it for this video, guys. Make sure to smash that like button and subscribe if you haven't already.